So today I'll be, as promised, I will revisit the foreign exchange related notes and further explain how to calculate, and also we will redo the sums I have shared with you, and I'll also give you the fundamentals and the logic behind that, so that you will be able to calculate any cross currency in the future. So don't worry, whoever who is interested can learn this, and if you find it is difficult, it's not difficult actually. It's very not rocket science. In banking, we don't have rocket science. So we all are very simple thing, but sometimes due to jargon, what we use and all, people get scared. Other than that, it's not a very difficult area. But being bankers, or you will be your career will be in the banking area. So it is good to know these things and how to calculate. And even if you come across any kind of even your friend or any other party, you will be able to explain if you have been asked to calculate or explain any thing relating to cross currency. So that's what I thought of, like allocate some time today as well to further explain uh, this area. Right. So far, I have covered last session, basically safe custody and safety lockers, then forex money exchange services, then executor and trustee services, and then sorry, I haven't covered executor, but I have covered bank assurance and money transmission services. That's 4 areas I have covered out of 10. Today I'll be covering the balance six. Balance six are not that difficult. Just fundamental understanding is only expected out of this session and this course. So if we are to learn further, if you have any interest in learning any other area, or pursue any specialization in these areas, then you can further study on these areas to get more knowledge, more practical exposure on the area that you want to pursue your career. Right. Let's start the foreign exchange part. We'll start with the foreign currency rates. So I will just we discussed last week bid and offer. Bid is the rate where the bank will buy the base currency. We will slowly go on, then you will understand very clearly. Bid is the rate that the bank is basically using to buy the base currency. Base currency is the currency that is always, you have one unit quoted against the other currency. Always in a direct quote we call USD LKR. The USD is the base currency. That's a one unit of currency is quoted against another unit of a currency. We call the base currency is the USD in this scenario, and quoted currency is the LKR. Always base currency is the currency, unit, one unit quoted against any other currency. So that's the simple meaning. So in any pair of exchange pairs, you have bid rate as well as offer rate. Bid rate is the rate at which the bank will buy the base currency and sell the quoted currency. So I have mentioned both here. Quoted currency, if you take USD, LKR, USD is the base currency, LKR is the quoted currency. if I want to buy USD, if I if I want to sell USD, bank will use the bit rate. If I want to sell LKR, bank will also use the bit rate. So the difference is here. Bank will buy base currency. You can highlight that, and also bit rate is used to bank to buy or sell quoted currency. Buy, sell. If I want to buy local currency, then bank is using the quoted currency selling rate, and that is the bit rate. Let me explain again. Bit rate is the rate at which the bank will buy base currency or sell quoted currency. What is the base currency in USD LKR? USD LKR is the quoted currency. If anyone wants to sell base currency, bank will use the bid currency, bid rate. If anyone wants to say LKR, anyone wants to buy LKR, bank will use the bid rate to sell that quoted currency. Simple explanation is that. Offer rate is other way around. Offer rate is the rate at which the banker or the quoter or the banker is willing to sell the base currency. Sell the base currency, USD selling rate. Bit is the USD buying rate. On the other hand, you have a LKR. LKR bank will sell using the bit rate. Bank will buy using the offer rate. So this is a theory that you need to remember, and it is easy for you to then calculate any kind of cross currency. Quoter is the bank or the authorized dealer. Asker is the customer. Then I have explained what is base currency, and I have explained what is quoted currency. Always the base currency is given as a 1 unit. Always base currency is given as a one unit. Now in Sri Lanka, practically we say $1 is equal to LKR 203. That is the today's selling rate. We don't quote other way around. If other way around, we call the indirect quote. This is a direct quote. USD to LKR is a direct quote, and if we say fraction of LKR 0.00 is equal to $1, that is called the indirect quote. That is called the indirect quote. That can be also, you can quote that way, but that is not generally accepted. That is called the indirect quote. Then two-way quote is you are giving both buying and selling rate. You are giving both buying and selling rate. Generally, you give the buying rate first, stroke, then the selling rate. If we say 203.50 stroke 75, then 50 is the buying rate, that is called the bid rate. Then 75 is the selling rate, that is we call the offer rate. Then cross currency is quoted against the third currency. Then the cross currency is coming to play. How you calculate the third currency using a third currency. For example, USD LKR, then USD JPY. You should know how to calculate JPY LKR or LKR JPY. Either way, you should be able to calculate. Then I have told what is direct quote. Then indirect quote. In a direct quote, always you quote 1 unit of currency against the other currency. Indirect quote, you get basically your home currency is quoted against the foreign currency. Then premium is when the future rate is higher than the spot rate. Spot rate is the rate at which we say 2 working days. Spot rate is 2 working days. We have cash rate, cash, term, spot, and future rates. Okay. Then spot rate is the rate after 2 days. So any premium, any future rate is more than the spot rate, it is called the premium. Discount mean any future rate is lower than the spot rate. Spread is the difference between the bid and the ask. That is the profit of any exchange, buying and selling. That is called the spread. Then I have given you the basis how to calculate. This is a direct quote, USD LKR, USD JPY. Then how to calculate, if you are given a direct quote, how to calculate LKR JPY. If I ask you to, then you have to divide. Then indirect. Here the both the USD is common and quoted against some other country, other currencies. So if you in these two situations, you have to divide. Thumb rule is direct. You have to divide the quoted currency by the base currency. If I ask you to say LKR JPY, then the LKR will be the base currency. Then you have to divide the divide the JPY by the LKR. Okay, that's a. If I give you the JPY against LKR, then the LKR will be the base currency. Then you have to apply accordingly. Indirect. You have to always divide the base currency by the quoted currency. Divide the base currency by the quoted currency. Then we'll move to the other calculation method, that is called the direct, indirect. Here you can basically change this. In this situation, direct or indirect. I wanted you to divide, and if it is direct, indirect can here direct, you need to multiply. You have to just change this. I will correct that slide again. So that's the summary: bid and ask, quota and ask, base currency and quoted currency, cross currency, and premium and discount. Then we'll move to basically for the calculations. Have you all done the calculations? The first question, AUD, USD, I have given a rate. USD, JPY, I have given a rate. First question, at what rate can customer buy JPY against USD? JPY against USD. What I have told you always, you have to look at the banker's point of view, not from the customer's point of view. But here, the information is important, because what if customer wants to buy, what bank will do? Bank will sell. If customer wants to sell, what bank will do is bank will buy. Bank will do the other way around. Now, I wanted you to understand the theory here. The question is at what rate customer buy JPY against USD. Then customer buy JPY is customer sell, the bank will sell JPY. Here JPY is a base currency or a quoted currency? Is quoted currency. Then what bank will do? Bank will sell quoted currency. Bank will sell quoted currency, but using what rate? Bit rate. Then bit rate is what? 8260. Bit rate is 8260. Then against AUD. Against AUD means what does it mean? Customer will sell AUD. Here, what is AUD? Is the base currency. If customer wants to sell AUD, what bank will do? Bank will buy AUD. AUD is the base currency. Bank will buy base currency using the bit rate. Using the bit rate. Bank will never ever lose any kind of money out of this operation. So bank will always make a profit out of this operation. So therefore bank will buy at a lower rate, sell at a higher rate. Buy at a lower rate, sell at a higher rate. Then you need to understand whether to multiply or divide. Now I told you, if it is direct, then AUD should be here. If it is indirect, USD should be here. Since it is not direct or neither indirect, you need to simply multiply. Simply multiply. Multiply what rate? Bit rate, and here 8260. And then you have to find the answer. You have to arrive the answer. At what rate, we'll move to the second one. At what rate can a customer sell JPY against AUD? Customer sell JPY. This is again the quoted currency. Customer sell quoted currency. Bank will buy quoted currency. Buy quoted currency using the offer rate. Using the offer rate. By using the offer rate. We call bit rate buy base sell quoted. Offer rate sell base buy quoted. So say buy sell buy. So that's the theory you need to understand. Then you need to apply the same theory here. Sell JPY is the quoted. Then bank will buy quoted. Buy quoted is this rate 8265. Then against AUD, same here. Then the customer will sell AUD, bank will buy AUD. Buy what? Buy base. Then the base will buy base mean bank will apply the bit rate. Then you need to multiply this by this. Then you will get a rate. So anything different to this have you all come across?
So same thing happened earlier also, no? That if we buy JPY, so normally we quoted 8260, no?
Here 65. Here I wanted you to apply. Now this is sell JPY, no?
Yeah.
Sell JPY means what will bank do? Bank will buy JPY. Bank will buy JPY is the quoted currency. Bank will buy quoted currency is this rate. Okay. Always bank buy the base currency. Base currency. This is anything to do with the base currency using the bit rate. Okay. Then bank will buy the quoted currency. Okay. Bank will buy the quoted currency using the offer rate. You understood the opposite of bank will. This is the rate where bank will buy. This is the bank rate. Bank will sell the base currency. On the other hand, bank will buy. Bank will sell the quoted currency using the bit rate and buy using the offer rate. So that is the theory that you need to understand. Then you can do all the questions without any difficulty. So let me. I have done a explanation. Then I will go through that. Then you will really understand how we have arrived the answers. Right. Okay. Now, this is the answer for what is the theory I have used. JPY sell is the quoted currency. Okay. First theory, customer will sell JPY. The customer will buy JPY in the sense bank will do? Bank will sell JPY. That is the quoted currency. Okay. Then selling quoted currency, you have to use this rate. You have to use the bit rate. I have at the outset, I have told you bank will buy the base currency using the bit rate, and bank will sell the quoted currency using the bit rate. This is the very simple theory. Then on the other hand, bank will sell the base currency using the offer rate, and bank will buy the base currency using the offer rate. So this is the explanation I have given to you. So here JPY customer, what customer can sell, customer can sell JPY. Here bank will buy JPY. Bank will buy base currency. This is wrong. Sorry, this should be, I will have to make a small, and you have to put the calculations right. This figure is correct. AUD by base currency. Then you have to apply this. Only change is these two due to the fact that buying and selling of APY by the customer. Is it clear? Is it clear? We'll move to the second answer. At what rate can a Sri Lankan make?
Excuse me, sir. The earlier one, that means normally we using same rate for that Australian dollars, no?
Australian dollars.
That mean
The same theory happens. Theory applies. There is a disturbance. I think someone's. I think mic is on. Right. So let me explain why the same. What customer does is customer sell JPY and then buy base currency. Buy base currency is right. Sorry, I have put the right answer, but I also made a mistake. Then bank will
multiplication. It should be 86.16.
At what rate the customer buy sell JPY? So we let it again, put it in a very simple way. Now, in first instances, customer buy JPY means bank will buy JPY, but bank will sell JPY. Okay. So against AUD is the base currency. So bank will buy base currency, that is 20.0420, and the bank will also sell quoted currency, that is the sometimes it may be a multiplication error, but these two rates are perfect. At the rate at which customer can sell JPY means what is JPY? Quoted currency. Then customer selling means bank will buy quoted currency. Bank will buy quoted currency using this rate. Then 65 is the correct. Then against AUD, customer sell quoted currency, bank buy, and bank will sell AUD. Bank will sell AUD at this rate. Then this should be, what is the amount? 86.
0.1626.
0.1626. This is the rate. So this should be the theory. Then we'll move to, likewise, try to understand the theory always. Then calculations can be done. Then for the second one, at what rate can a Sri Lankan importer buy CHF against LKR? Importer needs to buy foreign currency to import some goods. Then he has to give dollar LKR, that's the Sri Lankan rupee, and buy CHF. Then here CHF is the quoted currency. Understood? CHF is the quoted currency. Then CHF, if a customer wants to buy CHF, bank will sell CHF. Bank will sell quoted currency using this rate, bit rate. Okay. Then customer will sell LKR. Customer will sell LKR. LKR is a quoted currency here. Then buy LKR. Buy quoted currency by the bank using 130.30. Is it clear? Now, these are small steps you need to know. Always think what bank will do, whether bank will buy a quoted currency or a base currency. Always, if bank buy base currency using the bit rate, okay, and bank will sell using the ask rate or offer rate, okay. That is for the base currency. In a quoted currency, always bank will do the other way around. In a quoted currency, bank will sell the quoted currency using the bit rate, and bank will buy the quoted currency using the selling rate. That's the offer rate. So you need to understand this theory. It's not a big thing. Bit rate, bank will buy base currency and sell quoted currency. Bank will buy base currency and sell quoted currency. In using the selling rate, bank will sell the base currency and buy the quoted currency. In a bit rate, bank will use the buy sell option. Buy sell options in the buy the base and sell the quoted. Then selling, bank will sell the selling rate is the bank will sell the base currency and buy the quoted currency. So this is the theory, not a big thing, but when you go through this, you will learn how I have given you the calculations. And only thing is I need to do a small explanation how always you are given a say SOP points. Now here future rates, I told you what is the SOP is the future rates, that is premium and discount. If this is again a bid and ask, this is bid and ask. Now in this situation, theory is the same. You apply bid rate or the selling rate or ask rate on the, you have to look at the point of view from the banker's side. Only you need to know whether this need to be added or deducted. This need to be added or deducted. So that is all depend on, now if this rate, the spot rate here, bid rate is lower than the ask rate, it is always a premium. And you need to add. If in this situation bid rate is higher than the ask rate, 2 months, this should be 2 months. Then it is a discount. Then if you want to apply this rate for USD CHF, you need to deduct. So I have given the theory and give an explanation as well, what you need to do, forward rate, premium rate, then how to add or deduct. Then your answer should be, you have to arrive using that rate. Then I have given another example as well, how to use the spot rate. All these are explanations are given, but I can't remember whether I have given you the fifth one as well. But I have given the answer. If I have not given the fifth question, I will share with you as well. Any clarification up to now? Because it's very important to, if you have any doubt, just tell us, then we can explain.
So regarding that swap, 2 month swap, US dollar 200 to not 5. That mean so
Yeah,
that
it's a basis points. It's actually 2.5. It's like this 200 in foreign currency. 200 means it's you have to divide by 100. That's a one point is 100 basis points. 1 point. So here only two, and here point 220. You have to divide by 100, and then it will you have to get that value to either add or here adding. This is a premium. You have to divide this by 100. If you divide by 100, you will be it's a point. These are actually 200 and 200 and 205. I will make it easy since you will get confused. We'll make it like this, then it will be easy. Otherwise you need to convert it to the I have given in the points, basis points, so that you need to convert. But when you learn further learning, you should be able to convert basis points to rupees. So this is how even in your central bank they say 100 basis points, 200 basis points, but it means 1%, 2%. That's the meaning of that. Not by 100% or 200%. When they say increase by 100 basis point, 200 basis points, the interest rates they tell like that. Then that means 1%, 2%. That's the meaning of that. Right. So any other clarification? You things are basically doing this. I want to give you a different scenario. Here it's a premium. Here it's a discount. How it become a premium? Your bid rate is more than the ask rate after 2 months. Here your bid rate is more than the ask rate after 2 months. This is a discount. This is a premium. So if it is a premium, you have to add it, and if it is a discount, you have to deduct. So I have given this. I will ask Mr. Menaka to share the details with you, the detailed answer, so that you can work out and see on your own. Then you can look at the theory and understand the basis. Any other clarification you need?
so what kind of transaction normally we need to apply? So that means what kind of businesses?
Yes, now this cross currency is getting involved almost every day in a bank. But generally, when you are working in a bank, you will be, these rates are given by your treasury. But at least if you are, why we want to share that, for example, you may need to send Canadian dollars for your examination purpose to your university or you may need to send Australian dollars for a university payment. For example, you may need to send GBP for a university payment. Then in that scenario, bank will always quote a cross currency rate. There is no GBP LKR direct rate. So our currency is quoted against USD. Our currency is quoted against USD. 1 USD is equal LKR so much. Then the treasury will find out what is the 1 USD for GBP. Then they will calculate using the GBP LKR rate. and it will be quoted for the the bank others team members for them to do the transaction. If customer may come wanted you to send GBP, but whatever the rate quoted by the treasury, your treasury department is basically based on this theory. But they may not physically go and calculate all these things. They may have sophisticated calculators, so they may get the cross currency rate instantly. But this is, I want to share with you the basis in which these cross rates are calculated. Then you will have an understanding. The cross currency rate always in Sri Lanka, our LKR is quoted against USD. One USD is LKR so much. Then any other currency we want to transact for import purposes or sending any TT outward for some other purpose, even for export purpose. So if any other currency is involving other than the USD, this cross currency part is coming to play. That is the usage side of this. It is happening on daily basis.
So what are the forex accounts mean?
Forex?
Forex accounts. So normally a customer can open a forex accounts and they can invest in that forex accounts. The same they need to apply for this calculations.
Yeah, this calculation, sometimes customers can open two accounts, for example, 2 or 3 accounts in foreign currency. If they are smart enough, they are also knowledgeable. When the dollar is getting strengthened or any other currency getting weakened, you can transfer funds between these accounts and make a profit. That is possible. But you have to be smart enough, and then you have to transfer between your accounts at the right time, and then you can make a profit. So that is the cross currency is very, very important to know the cross currency rates, because if the dollar is getting strengthened, okay, you can buy more currency of some other currency. If dollar is getting weakened, you can buy dollars from using other currency. So that's the mechanism they use it. So forex trading is something like that, and it is, even if you can open 2-3 accounts with the same bank, using internet banking, you can transfer in between. But some banks may not allow you to transfer foreign currency to foreign currency accounts on your own using the internet banking. But you can instruct the bank to do that based on the movement of the currency and make a profit out of that.
Okay, sir. Thanks.
Right. Then we'll any other clarification, you go through this theory and find out whether your answers are compatible with my one. And I will also, at the end of the session, I will share my mobile number or the email. You all can have any clarification. I'm happy to help you out.
Yeah, so in your case study in the question number 5, so it's
Right.
mentioned March 21st, then rates April 15. So April 15 means normally we go through that current rates, no?
No, this is actually a question I had developed some time back, and you have to just think the March 21st is the date at which you are going to. Today is March 21st, and they have given you the April month details. Then you are expected to apply the right 1 month or 2 month rate. Don't you forget about the today's date. You just imagine today is I can if you want, I can change these dates to current dates, but these dates are given and applied. For example, AUD USD rate is this, USD JPY rate is this on the 21st of March. Don't think of today's date. You have to assume that you are in March 21st, and then if you are given the calculation to calculate in 1 month, 2 months time, then how are you going to do it? Value date is April 15. So this is at the now March 21st. 1 month is April 25th. Then you have to apply the 1 month rate. This is the learning that you are getting out of this. Sometimes these kind of calculations are involved in forward forward transactions. Then you have to understand, being a banker or even as a customer, it is important to understand these calculations, which rate you are going to apply and which rate that your payment will get due or fall due, so that whether you apply 2 months rate or a first 1 month rate. So that is the understanding that we expect you to learn out of this question. Right. Then we'll move to the today's session. So as I mentioned to you, I have covered the safety, safe custody and safety lockers, then forex money exchange services, bank assurance and money transmission services. So today I'll be discussing dealing and brokering services, executor and trustee services, investment management, private banking, wealth management, money laundering, constraint, and know your customer. But these are, honestly speaking, as I mentioned to, retail banking is going to be very, very tough in the future. And we, all of us, will find extremely difficult because markets are not getting expanded or getting expanded at a very slower rate. So there are so many banks in Sri Lanka. So we have to compete each other to get the same market share. So bank will not be able to only manage with traditional deposit taking and lending. So therefore, day by day, the net interest margin is coming down, getting shrinked. So to support that, interest income alone is not sufficient. So therefore, banks are looking at having a different kind of fee-based income by offering ancillary service other than the traditional service of the bank to the customer base. So these are the things that they are making money by way of a fee-based income or a commission or whatever name, other than interest component, by offering these services. So what is a dealer? What is a brokerage? We call the broker. That's a correct word. Is the brokerage? We call the broker. In a very layman's term, broker is a person who, or a middleman who connect two parties, or a buyer and seller. Buyer and seller basically, and he receives a commission out of that. The similar services are offered by bankers as well. Similar services are offered by bankers as well as a specialized services. Some may have different arms under them. Some may have different arms under them. Some services are offered within the main banking framework. But whatever said and done, it will be an intermediary service offered by the broker and facilitate a payment between two parties. This can be a individual or a legal entities can act as a broker, but in a bank it is a legal entity, not an individual. The broker perform its action according to the client's instruction. It is very, very important. It's a broker alone can't take decisions, but it is based on the client's instructions. The broker gets a flat fee or a certain percentage of a transaction amount based on the nature of the transaction, industry practice, regulator standards, client agreement, whichever is applicable. There are brokerage standards of standard fees stipulated by regulator. If you take share market, this is the rate, that is the maximum rate has been stipulated. So you can't come and different agreement to charge more than that. Sometimes maybe less than that, but not more than that. There will be country regulations. There will be industry practices. Some say it's 3% for some land transactions, so something like that. So you can have your agreement, but that agreement cannot be detrimental to any other regulator or country law regarding this brokerage fees. So this is what I want to specify. There are brokerage charges stipulated by the regulator on certain areas. So that has to be need to be complied. Then we'll move to what is a broker firm. There are a lot of broker firms in Sri Lanka. A broker firm is a legal entity who is licensed by the Securities Exchange Commission of the respective country to perform brokering services. So if you take, there are a lot of companies who are some are under banks. For example, NDB, they have, then the Sampath Bank, they have, the HNB, they have their brokering companies. So under different, some may have the 100% ownership, some may have a sizable investment. So those things, but it should be a legal entity who is licensed by the Securities Exchange Commission. Otherwise, they can't be a share broker firm. They facilitate buying and selling of equity means the shares of its own account through their own account or their custodial account. Custodial accounts are the accounts that they maintain on behalf of the other parties, other customers, under different agreement. In addition to that, they buy and sell equities on behalf of its customers. They do trading or the buy and sell equities on behalf of their customers. So being a broker, you can buy and sell of equities on its own account, or through the custodial account. In addition to that, they can buy and sell equities on their own on behalf of their customers. When someone execute orders on behalf of his customers or a clients, they are known as broker or an agent. It is very important, when someone executes orders on behalf of his clients, they are known as broker or agent. These are broker or agent is the same one and same. Then when it trades for its own account, it is known as a dealer or a principal. If you are doing a trading on behalf of a client, you are known as a broker or agent. If you are doing a trade on your own, you are basically known as a dealer or a principal. Generally, a dealer is more than a broker, and professionally they are more matured, they are more experienced, their exposure is higher. So gradually the brokers will become dealers later. So it's a higher elevation, is a dealer position or a principal. To manage a fund, company requires unit trust license from SEC. There are unit trust under certain bank, different arms that requires a special license from SEC. Unit trust is the fund. There are small time investors. They may not be able to, number one, their capital is not adequate enough to, invest in a big way. Then their knowledge may be not sufficient enough to engage in these, investments. So therefore, there are unit trust where they facilitate small timers, small investors. They collect funds from them, and they have developed a bigger fund and invest on diverse, investments, shares based on the different type of requirement of customers. In return, they share the profits among the basically the unit price will goes up, and they make a capital gain, and that is the benefit of under the unit trust. Small timers, this is basically meant for small time investors. Then different type of brokerage specializations are there. Stock brokers are there, credit brokers are there, leasing brokers are there, forex brokers are there, real estate brokers are there, business brokers are there, insurance brokers are there. As far as the banking is concerned, number one, stock brokerage is very important. There are subsidiaries of main commercial banks who are engaged in stock brokering. They have their license independently. They have the license to do that, and they add a lot of value to the group bottom line. And also the forex brokers, there are different type of forex brokers, and some people use or obtain their services to get the rates from different banks. For example, a foreign party or a bank or even a local bank wants to sell certain amounts. They can go through the broker, or they can come to one bank. Then bank will quote two-way rates like 200.50 stroke 60. So that is the decision they have to make based on the one bank. If you go through the brokers are there. They have the link with all the banks. They are operating globally. They have the bigger platforms. So they get the rates from all the banks, and they share the highest and the lowest bid and the highest offer from the basically highest bid and the lowest offer from the different banks. They share with their clients. So then client can, if he wants to buy, they use the highest bid. If you want to basically then they want to sell, they want to sell, they use the bid. They want to buy, they use the lowest offer rate. So this is a day-to-day happening thing, and this is a very famous thing, this brokers involvement in forex trading. Then we will move to dealing brokerage service. We will continue. Facilitate buying and selling of equities. That's stock brokering. License is required. Without that, you can't do that. They do underwriting of equity and debt securities such as IPOs and debenture. What do you mean by underwriting? Equity, debt, securities. So this is very important. Underwriting. Sometimes IPO, you must have heard this word, initial public offering. The companies, when they want to list in the stock exchange, they do a IPO through a underwriter, through a dealer or underwriter. What they do is they do the prospectus on behalf of the company. They do the research, they do the valuations, they all do on behalf of the prospective company, and they sell and say, for example, if they expect to raise 1 billion out of IPO, they underwrite. If it is undersubscribed, they will buy the balance of that amount of the IPO. So that is the underwriting. Even debt securities like debentures, most of the companies or a bank for that matter, they issue debentures to raise funds for different purposes. They have Basel III requirement, so they want to support their tier 2 capital. So they, from time to time, they issue debentures with 5-year, 7-year horizon with the time span, and these are issued through investment banking arms of different registered companies in Sri Lanka. Some are under banks. So these debentures are issued by these brokers. Equity research, they publish research report with buy, sell, hold recommendation respective person, and in order to give buy, sell or hold recommendation, RIA certification should be there. Should be this is issued by the Securities Exchange Commission. Person should be qualified with RIA for him to give a buy, sell or hold recommendation to any third party. So this is a must, and it's a compulsory thing to have this qualification. Then you need to fund management functions is also done by them. Fund management, that's the investment manager license is required. Fund management. Then unit trust, I have told you, unit trust license is required. Then providing margin facility, margin provider license is required. These are the licensing requirement for different kind of services that need to be offered under different services. You can't just go and provide these services without any licenses with the registered regulator. So margin facility means if you have a portfolio. For example, you may have commercial bank shares, you may have Sampath Bank shares, you may have HNB shares, you may be having NDB shares, you may be having LOLC shares. So likewise, you may have a different portfolios. Out of your portfolio value, your service provider or your broker will provide you a special facility to lend money based on the value of your portfolio. 30% you can immediately take as a loan. We call that is as the margin facility. So you can buy 30% out of your portfolio, and even without money, you can just get 30% loan from your company from whom you are maintaining your portfolio, and buy shares. So the danger is that when your portfolio is supposed to fluctuate based on the prices in the market, if the portfolio falls beyond your certain limit, or basically 50%, your margin will be taken by selling your portfolio. Basically, your portfolio will be sell by your broker and recover the loan. So that you are running a risk of having this 30%. Sometimes you can make a profit as well as you have a risk as well. If you don't manage it properly, or if you don't have cash to support in the event of market is highly volatile and when the market is coming down, a bearish situation, you should be able to cover your margin requirement on using your own funds, rather than allowing the broker to sell that and recover it. If you allow them to recover your margin by selling it, what will happen is you will make a huge loss. Then functions of a broker. Functions of a broker: execute trades on financial markets at the expense of customer and on his behalf, provide information support about the situation on trading platforms, sending notification about codes and trading mechanism. So these are the general functions. You need to have RIA as well to share these certain opinions, provide information about the market participants, making the correct decisions for the client to conduct transactions, then lending to clients for margin transactions, storage and protection of customer data, creating a technical base to make transaction on the exchange. Then certainly the broker companies carry out a broker activity beside mediation. Without a broker, the financial market itself would not be exit. So the broker plays a pivotal role or a critical role in the financial market to connect both the buyer and the seller, advise them, give them professional advice, and make the financial market inactive and kind of volatile due to the involvement of broker services. Then summary: a broker is a person who executes the trade on behalf of the customer, whereas the dealer is a person who trades business on their own behalf. That is a subtle difference of the broker and the dealer. The dealer is a person who will buy and sell securities on their account. Dealer is a person buy on their account. On the other hand, broker is the one who will buy and sell securities for their clients. Always the broker is the person at a lower level, so he interact with the customer, individual customer. Dealer is at a higher level with more exposure, more experience, and they handle bigger volumes, or basically the institutional kind of things. While dealers have all the rights and freedom regarding the buying and selling of security, brokers seldom have this freedom and these rights, because generally broker doesn't have that kind of freedom to take decisions. A broker has only a little experience in the field compared to dealers. It has also been seen that broker become dealer when they get experience. So that's how they elevate. Broker will elevate to the dealer level with the experience and the time. Broker is normally paid a commission for a transaction of the business, but dealer is not paid a commission, and he or she is a primary principal. He's a principal. He is not working on commission. So this is the summary of broker dealer services available in Sri Lanka, basically, and some of the banks have already stepped into these areas and making a money that will also really help them to divert their own customer base to these services and get a maximum out of that particular customer, or provide one stop kind of a solution, roof solution to their customers. So otherwise, they will shift to different arms to get these services done. What will happen is finally they will capture or they will shift, request the customer to shift other businesses to their other related companies. So to prevent that, all the banks are now providing these services under one roof. So there is another area that the executive and trustee services are offered by the banks. Due to increased competition, modern commercial banks have extended range of financial and non-financial services to their customers beyond their traditional functions of accepting deposits and lending money to support their net interest margin. That is the at the outset I told you, this is very critical, because all the competition is such that all the banks find extremely difficult to have a decent margin out of their operation. So you must be aware that the investment of banks is high. So when you really compare the return on investment, we get a very negligible amount. And when you compare with our asset base of banks and the annual return, it is 1.5% of the asset base of many banks, or some are less than that. So that is a very challenging. But if you go to a market, they will say, oh my God, this time this bank has made 15 billion, 20 billion, 25 billion. But none of them are comparing the investment made by the banks and the asset base used to generate that kind of a investment. So when you really compare, the return is only very in the less than 2%, I would say, mostly 1.5%. But in other areas, their profit margins are more than 10 to 15, some cases 20%. But in banking industry, the margin is less, but even though you see a bigger profit. Then following services are also offered by the banks to their clients. That's called the agency service. Banks as a trustee, bank as an executor, bank as an administrator. These are technical things. You need to know the basic understanding you have to have of these services. Bank has an agency function for many services. That's the nature of the banks. So for example, collection of checks. We do basically we collect checks for from our customers and send for clearing to other bank. That is a agency function. We as a collecting bank, we do a agency function. Then we collect dividend checks on behalf of the customer. That is a agency function. Then we collect interest from different sources on behalf of our customer. That is a agency function. Then making and collecting of payments. So we make payments on behalf of the customer, or maybe a utility bill, maybe some regular insurance payment, maybe some other payment of customers. So that is also making on behalf of the customer, maybe a school fee, whatever we do on behalf of the customer. And sometimes we collect payments of the due payments of the customer from different parties. Sometimes through the network, we will have a collection account, and their customers will come and put it to that account. Or we collect payments directly to his account. Now, if you go to a bank you can go and make the your utility bill, electricity bill or water bill or your mobile bill or your land phone bill to a bank. That is an agency function. That is an agency function. So you just collect the payment on behalf of your customer. Accepting bills. This is relating to foreign trade. So that is also agency function. Remittance transactions, issuing reference letters. Your customer will come to bank and wanted you to send a confirmation letter, balance confirmation letter to an embassy. That is the agency function. You are doing at the request of the customer. You are acting as an agent of the customer. Then conducting foreign exchange transactions. That is also you are doing as an agent. Payment of subscription, rent, insurance premium, and act as an executor, trustee. That is also agency function, but it is slightly, I will explain as we go on. Collection of bills under URC 522, that is documentary against payment, documentary against acceptance. These are all agency functions. That is not beyond that. Then we'll move to bank duties of banker as an agent. This is very important to know. Bank should get clear instruction in writing from the customer. So it should be whatever you do need to be in writing, and it should be there can't be any kind of it should be clear instruction. There can't be any kind of ambiguity or unclear instructions, which will later give rise to a controversial meaning. Okay, so that is a very important thing. So there will be very precise, clear instruction from the customer as to what the bank should do. He can't come and later he can't come and tell a different story. So therefore, it is very important when you do act as an agent, you have to have a proper instruction, a written instruction from the customer. The bank may also not accept any instruction which are difficult to comply. Sometimes, you may not be able to comply or, carry out that instruction. But in that scenario, we should not, as a banker, should not accept such instruction from the customer. If you can't comply with that, it is very important. Otherwise, he will find fault with us, and he may resort to some legal action for suffering certain losses or any other. He may claim damages from us. So therefore, we, prior to accept all such instruction, we should know whether whatever the instruction we agree or receive are we can comply with that. Without if we can't comply, we should not accept such instructions from the customer. Then once the bank accepted or undertake any act to perform on behalf of the customer, bank is obliged or has a duty to carry out such instruction. So once you commit, you can't say no. You can't say no. Then there should be a valid reason, or after, say, you are accepting that if the country law has changed, a new regulation comes, then you have a defense. If there is no change to the law, if no regulation has changed, then you can't, you are bound to do that. Then you are bound to do that. Most banks use standard formats by incorporating required protection clauses to get the instruction from their customers. Sometimes any instructions, all of us are using a standard formats for customers to give us their instructions in writing. So those instruction forms, all the required clauses are incorporated, and indemnifying the customer, indemnifying the bank for any future losses or any other thing. So you exclude all your liabilities through the written or the standard format. So that's the advantage. Since customer wanted get to the bank to get this done, they will sign it. But most of the letters that has given the protection to the bank in many ways. So whether this is and also there is a charter, customer charter. Therefore, we can't incorporate all unethical, unreasonable, unfair terms and conditions to the agreement or the any form. So it is very important to comply with those things as well. You can't, incorporate terms and conditions the manner in which you want, but it has to be fair by both parties. But when you are doing that, your legal team will try to give the maximum protection to the bank in any agreement. If you take a leasing agreement, if you take a loan agreement, if you take any other agreement, that will have the required protection to the bank to protect bank interest. So that's the normal standard way of doing the banking. And many customers are also not reading, and they are just signing. We also do like that. If you go and if you want to get a credit card, you just go and sign it without even reading, because you want only the credit card, but you don't know what you have agreed or accepted by making the signature. So it is important to know that. And if later if you challenge it, the bank will come and tell you, you have agreed to this clause, you have agreed to this term, you have agreed to this, and then you can't do anything. That later you can't say it's unfair, or you have signed with undue or duress or whatever. You can't later you can't tell anything like that. But generally and globally, uh, even though we are not doing here, it is the responsibility as a responsible bank or the person who is handling a professional to explain the terms and condition to the customer. It is the general globally accepted this, and after understood the terms and condition, understanding the terms and conditions only, he is supposed to make the sign and agree with the terms and conditions. So that's the, but the in the our business environment, those things are not practical because of the time and understanding levels are different of the customers, and they may, even if we explain, they may not really understand what it is. So these finally no one will, I have seen that, explain any of the agreement, but they just sign it. If it is a loan, none of them will read the agreement. They just bank will show the places to sign, they just place the signature only. So later they will may not be able to sometimes go against the bank, as they have agreed to those terms and conditions. So being bankers, and it is when at least in the future you should be able to at least uh, make the customer aware of what he is signing, and also when you get the instructions, also you need to read and understand, and also whether what are the liabilities that may arise of accepting that instruction or not carrying out that instruction. that understanding should be there as a banker. Then we'll move to bank as a trustee. This is another service available. A person may desire that after his death, a part or whole of his property be held in a trust for the benefit of various beneficiaries named in the will. So this is actually a trust can be established before we die. Before we die, even after our death also we can do that. But while we are living, also we can set up a trust for a given purpose, and then open a trust account with the bank, then have a trust deed and operate this account according to the terms and conditions set out in the trust deed. So that is also possible. But at the same time, I can also write a will, last will, and after my death, I can specify in the last will who are the beneficiaries of the properties that I own, and then the bank can be nominated as the trustee. So that it is the duty of the bank, after proving my last will in a court, to obtain a letter of probate and then open a trust account. Then the bank duty is to hold the trust, hold the properties for the benefit of the beneficiaries named in the last will. So that's the overall view of that. In such a case, he may be created a trust under his will, directing a certain person to hold property to such person after specified time. When the banker takes the liability to administrate of this type of property, he will be called trustee. Bank is expected to act as a trustee as per the trust deed for the sole benefit of beneficiary or beneficiaries. It's very important. Bank can't go act contrary to the trust deed. Bank cannot act contrary to the trust deed. It's very, very important to go act in accordance with the trust deed. So that's a very, very important thing. So bank will get a fee for managing the trust property. So that is another thing. These are a little complicated and not very freely seen, but however, the banking system, these things are available. Even though it is not common in every branch, but these things are available. But some trust have been established for different purposes by different people. That is also possible. Suppose if all of us want to create a trust for the benefit of, say, needy children, that can be established. Then we can have to set up a trust deed and articulate all whatever the terms and conditions and open account with the bank, and bank will act only upon the trustees instructions. So that's the basic idea of trust. Then bank as an executor. A person may make will expressing his intention regarding the disposal of his property after his death. There are two words here. Now we discussed about the agent, bank as agent, then bank as a trustee, then executor, and there's another word called the administrator. We'll be discussing next. Executor will be, this is a subtle difference is there. A person may make will, that is the last will. Person may make will That is a last will expressing his intention regarding the disposable of his property after his death. When you die, we call with a will, we call the estate. You are die with a estate, that is with a last will. You are die with a last will. The people have to, the beneficiary or who are going to be benefit out of the last will, need to prove the last will in a court and obtain the letter of probate. Letter of probate. So in a letter of probate, a person who has made the last will must have mentioned a name of an executor. It can be a bank. So then, as per the letter of probate, the court can appoint the bank as executor. Then bank has to manage the property or dispose the property as per the last will or as per the letter of probate of the person who died. So this is a simple operation, not a simple operation. I would say it's a complex operation. But again, bank will also get a fee out of this for this operation. A will has to be in writing. Always last will has to be in writing, signed by the person making the will, which called the trusted and attested by 2 witnesses. So will has to be always signed by, it should be in writing and it has to be witnessed, and later it has to be proved in a court. So it will become effective only after it is approved or proved in a court as a private. A private is a copy of the will duly certified under the seal of the court together with the grant administrator. A person appointed as administrator of the deceased is known as an executor. The person appointed as an administrator of a deceased is known as executor. The bank may appoint as an executor of such services. Please remember this one. The person appointed as administrator of the deceased is known as executor, because we are going to discuss what is an administrator in the next slide. So you have to understand the subtle difference between executor and administrator. So let's move to the administrator. In case of a person dies without making the valid will, the property of deceased may be administered according to the law. The bank may be appointed to the administrator, administer the property, and then the bank will be called as administrator. So you need to understand the word executor or the administrator comes from the last will, whether the last will is there or not. It's mainly if the last will is available and it is proved in the court will appoint an executor. If there is no last will, if anybody dies without the last will, we call the intestate. Then the dependent or the beneficiaries or the dependents need to initiate a legal action in a court. Then court will appoint an administrator after administrator to manage the property or dispose the property. With a view to dispose the property, the court will appoint a person called administrator. If there is a last will, it will be the executor. So they're almost the same role, but 2 different names based on the availability of last will or not. availability of last will executor, availability not available, availability of the last will, it will be the administrator. So that's the difference of administrator and executor. Then we will move to private banking. Private banking, again, the private banking is where you always, all the banks for that matter, they will have a very exclusive unit to cater to their high net worth customers, because they have their bargaining power is high. They are demanding. They demand many things from the bank for to cater to their diverse requirements of their high net worth customers. This private banking units under different brand names are available with all the banks. They call say premium, they call, one may say platinum, one may say you know uh, some other name. So there are a lot of brand names used by different banks, but overall they whatever the name they call, they use mainly, these are meant for high net worth individuals, not even for corporate customers. This is a high net worth individual. And they provide a lot of personalized services, wealth management, and other services, investment and portfolio management, tax services, insurance, advisory, trust and estate planning for short and medium as well as long term. It's all depend on bank to bank. Some banks, they don't have the expertise to provide all these services. Some bank, they have that. Even they mainly depend on one or two people. Sometimes there is a risk as well, because these private banking customers, or the people who are engaged in private banking, they also do have a demand, and they are shifting to another bank is also on the card. So that's there is a demand for them. And if any bank wants to set up a new private banking, they may need to get a person from experienced person from another bank. They will not try out with a very junior person. So the risk is, if a person shift to another bank, there is a likelihood of shifting customers as well. To some extent, at least the customers handled by them, handled by that particular individual. So part of customers will be moved out of the bank, unless they have a brand loyalty to that particular organization. Then private banking is getting popular, very popular. Then we'll see what are the privileges offered by private banking to private banking customers. Excuse me. As I mentioned to you, that demanding power or the bargaining power is very, very high. They are sometimes they are highly influential community. They are well connected to a privileged community. Sometimes they are connected. They are opinion leaders, and also they are sometimes they are owners of multinational or maybe big companies in Sri Lanka. Their position power is very, very high, so they can canvas more business, or they can divert more business based on their words. So there are a lot of people like that, exclusive people like that. So it is very important for to cater to this community of multiple purposes. So bank has designed their products and services to cater to this community, to make them to keep them with them, and sometimes profit may not be that great, but still having them under your belt or under your say your brand name, it may be a advantage. So these customers, as I mentioned to you, are very kind of very powerful. Bargaining power is high, and all other banks are also eyeing to capture them at any time. So it is because of that they have their, I mean, bargaining power very high. So they can negotiate with the bank for special tariff, preferential rates. So these are very normal. If you are a privileged customer or a private banking customer, you are given a higher rate than any other customer. Sometimes you can't charge any charges, any tariff from them, because they will challenge you. And this segment is knowledgeable. They are well educated, and they know these terms and conditions. They know charges, what are the charges. They know they have large deposits with the bank. So because of that, they demand that if you don't take this charge out, if you don't take this 100 rupees out, 200 rupees out, I will move my deposit out of your bank tomorrow morning. So that's the pressure they put in or exert to the private banking unit. Then portfolio management and relationship banking. So private banking, sometimes these customers are they have many other work as well, so they can't focus on managing their each and every activity, especially the financial related things. So they let the bank to manage their portfolio. That is basically, some banks, they portfolio meaning, some banks, they are deposit based. Sometimes they may have their savings account, they may have a money market account, they may have a fixed deposits account, so different maturities. So they want the manager to advise accordingly. Some may have shares, so that they have given instructions to manage that as well. Not every bank, but some banks, they manage that as well. And relationship banking is the where you have a dedicated person to cater to each and every customer. So one relationship may be handling 10-15 customers, or little more than that sometimes. So they will be getting a dedicated specialized service from through that relationship manager. Then you have equity investment advisors. Then you have insurance cover, in the sense free insurance cover for your credit card. Sometimes you may have a free travel insurance for your credit card. So you have a investment planning advisory from the bank. Then free travel insurance cover for your debit card as well. Free branded checkbook, sometimes free credit card, no annual fee, no joining fee, no annual fee for debit cards. Loyalty offers, each and every bank is now offering loyalty points. These segment gets more because they are using the highest credit card. Then you send complimentary gifts for their birthdays, sometimes dinner vouchers, sometimes different vouchers from different hotels, then the supermarkets, then airport launch access, free airport launch access. When they travel, they can go to airport launch and use the facility. Then free online banking, safety locker facility. Sometimes most of the even we can't charge anything for safety locker. So parking facilities, doorstep banking. Sometimes these are the challenges because they demand. Send my money. I want 100,000. You have to send money to my home. I'm at home. I can't come. So these are the challenges we have. These are the dedicated, committed services offered by offered by banks to their private banking customers. Then what are the advantage to customer? They have the privacy. Privacy in the sense they don't have to discuss with each and everybody. They have a dedicated relationship manager. They can discuss with them, with him or her, and the privacy is assured. They don't discuss their wealth or their other related financial things with any other party. So the privacy is assured. Then preferential pricing. So advantage is always, if it is a deposit, they get the highest rate. If it is an advance, they will get the lowest rate. All the charges are waived off. So they get credit card, debit card, and safety locker facility, plus loyalty points, plus airport launch access, plus gift for the birthday, dinner vouchers, holiday vouchers. So all these things are they are getting. Then they get one-stop shop. They have the one-stop shop for all their banking need. They need only to contact the relationship manager for a loan or a card or a deposit, anything. They need to contact only one person, so that person will coordinate and provide the required solution to the customer. So dedicated relationship manager is key, and he's or she need to coordinate with the respective departments in the bank and get the requirement done for his or her customer. Then the recognition. When customer sometimes even customer calls to the call center, these privileged customers are being diverted. Their calls are being routed as a priority call. There a lot of call centers have been configured like that. So sometimes they can be identified by the name. Sometimes immediately they can attend. Then they can, even if they walk to the bank, they will be immediately recognized, and through sometimes some may have privilege cards there. So this recognition is there all the time. Then they have a lot of privileges, as I mentioned to you before. So they have privileges more than any other customer. I would say more than any other customer. Even when they go to the walking to the bank, they get their refreshments, coffee, tea, or whatever. Then sometimes they are served with sweets, biscuits, chocolates. So these are for privileged customers. So these are the privileges they have. Then they are getting a personalized service. Personalized service through the dedicated relationship manager, and they need not sometimes they only are one call away. Then also the concierge service. Concierge service is where when they getting to the bank for the assistance of parking. Then when they get the sometimes getting to the bank, we arrange their travel requirements. Sometimes we provide insurance covers, coordinate with the agents. So these are the other additional services provided to this community. Then disadvantages to the bank. Advantages: high net worth customer portfolio. As I mentioned to you, this may not sometimes honestly be profitable sometimes, but it is nice to have this community, because out of them we sometimes we get more other business opportunities. Sometimes they may be a owner of a huge multinational company or a big company. So he may request their recommend the bank for their employees. Then their loans, other deposits, all will divert to that particular bank if they are happy with the personalized service what they get from personal banking unit. And even if they go to a shopping mall or a supermarket, if they use a card of a branded card of a bank, that itself is a kind of a privilege for the bank. And even that cashier will get to know that he's using what is the bank name and all. And this personality using carrying a brand name of that bank is a critical thing, as far as the bank is concerned. He will become a kind of a brand ambassador for that particular bank. So that's the people of that nature are the people who are fall into this category. Then cross-selling opportunities. There are a lot of cross-selling opportunities for this community. They have multiple needs, and they sometimes they change their vehicles frequently. They want to buy apartments. Sometimes they want to have a holiday resort. So build a holiday home in a remote area. So these things all can be identify and finance through the bank. So these are the opportunity, cross-selling opportunity available. Sometimes they may have grandchildren. They may not want to open a minor savings account for them. So these are the cross-selling opportunities, and even the grandchildren will come along with them to the bank, and they will also, from their small days, they will also get familiar with the bank environment, the name of the bank or the brand. So they will also, when they grow, they will continue to bank with that particular bank. So that's the kind of advantage to the bank. Then most of them are opinion leaders. So they are making an opinion about the bank, maybe good or maybe bad. But these opinion leaders are very important. So they carry a message to the community, and they associate different kind of community at a very high social status. So in those circles, it's very important to promote your bank brand by those people. And sometimes they share their experience, customer experience with them, their friends, over a party or a drink or whatever. That is going to be very, very important. And sometimes they may canvas their close friends to the bank, the high net worth friends to the bank business circle. because that's all depending on the level of experience that you provide through the private banking to that particular customer. Then your brand image is which we have discussed also. The brand image sometimes goes up when all top people are associating your brand. Then they talk about high about you. Sometimes bank will give gift items, t-shirts, caps, and sometimes watches, sometimes branded pins, wallets. So when they use it, so your brand, your image, your logos will be known to others as well, and they will also feel very proud, and they will also defend the bank any sometimes in any other forums where some others may challenge. So these are the things that it's good to have these advantages having this kind of segment. Then what are the disadvantages? As I mentioned to you, we have a very low margin, honestly low margin, but good to have this community. But it's a disadvantage. But more staff to provide personalized service. Now these people are not actually basically they want the A grade service from the bank. Their customer experience is the key. Because we some good old days we were discussing about delighting the customer. Delighting the customer means you are satisfying the customer for a given situation. So next point, customer may be unhappy. Therefore, we need to ensure customer experience, manage the customer experience using the all touch points of the bank. So that is a very critical challenge all the banks will have in today's context, because we need to have more team members or the staff members who are competent and knowledgeable to provide required solutions. So having that kind of people in all touch points is practically difficult. So then it will be cost will be increased. So these people expect their whatever requirement will be attended immediately, and also need a personalized service. So which will increase the cost of the bank. Then bargaining power of the customer is very high. If we don't accommodate their request, they will immediately shift to another competitor. Complying with regulatory requirement may be challenging. Excuse me. So now I am supposed to do the certain something related to compliance, that is know your customer and AML requirements. So under that we will discuss in detail. But complying with, I will just explain and give you a brief thing. These customers just call and inform the manager to transfer funds, but technically internal regulation or external regulation will not give us a luxury to do to accommodate such requests. But if you don't transfer, the customer will be unhappy. This is a challenge we have. Then they will say, I will send the letters later, or they may not send the letter. Then they want us to transfer certain funds from their own account to another account. or they want to do various other things. They send, their servants to get certain things done. So these things cannot be taken, cannot be, accommodated within the regulatory framework. Most of the things, but they want these services. They want these services. This is the challenge we have. For that matter, all the banks have how to accommodate the customer requirement and also comply with their internal audit requirements, compliance, and manage risk levels. Because even if you do something, without in writing, and we don't know what will happen to, all of us tomorrow. If that customer dies, there we discussed about the last will, we discussed about the other things. If they may sometimes challenge that this particular transaction has been done by the bank without the proper written instruction of the customer. Then that can be challenged. And then bank may not be able to provide any authenticated document to that regard. So these are the challenges we have. Sometimes we have provided them the online banking to many privileged customers, but still they may not use that, or they want the easiest way is to give a call. But in future, banks will have to come up with some kind of a control, or have a call recording or something to safeguard their side for these kind of requests. Then money laundering and constraints and know your customer. These are the other areas. So far, I have covered from will just go through, recollect what we have done. Safe custody and safety locker, forex money exchange services, bank assurance and money transmission services. Then I have covered dealing and brokering services, executor and trustee services. Then I have covered the private banking. Then I have covered so I'll be covering money laundering, wealth management, and investment management. And also I have covered and shared with you the calculations regarding to the cross-selling, cross-currency. And to summarize this, we have covered dealing and brokering and other related topics. So now we will move to compliance part, the very important area as far as bankers are concerned. Because day by day, the cost of compliance managing risk is increasing, and day by day the regulator is introducing different type of regulations, and wanted all the banks to comply with that. Those regulations. So it is a very challenging thing, and we have to allocate or set aside a sizable number of staff to comply with these regulations. So money laundering, constraints, and know your customer is one of the key areas that you should know for your future banking. Otherwise, you will be probably get into a lot of issues. People are a lot of try to do money laundering, and if you don't know about the customer background, that will also lead to a major problem in your future dealing. What is money laundering? Money laundering is the process by which criminals use the financial system to hide the criminal origin of the proceeds of crime, turning dirty money into laundered money. This actually this name has come from 1980s. This name came from how this started was in US, how they have laundered money. A person who has used money by illegal means, finally he has set up a kind of a laundry machines where you can come and put coins to that. So that is the name money laundering came from that. So then he has used that laundered money. Through the people they need to come and put money to the machine and get their washing done. So these later, these machines have basically laundered the dirty money to a clean money, and this name came out of that operation. So that's the history. So how people use money laundering? For why? A lot of people are making money using drug trafficking. So they use all illegal channels for this drug trafficking. Then human trafficking. So a lot of people are taken for different countries by illegal means, not through the normal legal channel. So this is called the human trafficking. So they take money from these people and let the people to move to different territories of other countries. Then bribery and corruption. This is very important area. Lot of people make money. They demand money. They do all illegal things, and they make money. Then extortion and blackmail. A lot of people, they make money out of that as well. The blackmailing is very common now. Sometimes they use different methods to do that. Then theft and frauds, very common thing. And illegal gambling. Illegal gambling is also a very famous thing. Then terrorism, organized crimes. So people are engaging in all these activities and making money, and these money have not actually declared and declared as their own money, and it has not even come to their hands through the formal way. It has not come to their hands through a formal way by doing a formal business. So they can't make use of this money for legitimate purpose. So they can otherwise they can't make this money for legitimate purpose. So there is no point of having money earned through this illegal means if they can't use for legitimate purpose, to buy a property, buy a vehicle, invest in a company, take ownership of a company. So those things cannot be done because these money have been earned by illegal means, and they are unable to show the source of funds for to make the make the formal deal. So it is very important to know how people make money through drug trafficking, human trafficking, bribery and corruption, extortions, blackmail, theft, frauds, legal gambling, terrorism, organized crimes. So, being bankers, it is very, very important to know these things, and you should have to have a sense of, identify a customer and profile the customer in such a way to identify his income sources, the level of income, and even in your systems, it has to be customer has to be profiled so that anything falling outside that his expected income or the normal income will get screened and have a additional alert of those income for the people to have further investigation. Then terrorist financing. This is another term. The financing of terrorism is the financial support in any form or the terrorism or to those who encourage, plan, or engage in terrorism. Terrorist financing is a global concern, and all the countries are on high alert, as well as entire global network is try to crack down terrorist financing sources or channels. So therefore it is very, very important to identify source of funds, whether this is for terrorist financing, whether we have people have received through these kind of activities. It's very important because bank may, why it is important, bank as we go on you will understand, banks are required to comply with certain rules and regulations by law or as well as by the regulator. Otherwise, bank will be exposed to a huge risk of paying fines for non-compliance of these things. Then there is a risk of getting blacklisted by the global organizations as a individual bank or a bank as a country. So therefore we are, whether we like or not, we need to get ourselves the processes in place to monitor all these activities. Then what are the negative effects of money laundering or financial sector? Money laundering erodes financial institutions. Money laundering erodes financial institutions. By increasing the probability, individual customers will be defrauded by corrupt individual within the institution. By increasing the probability that the institution itself will become corrupt or even controlled by criminals' interests, again leading to a customer being defrauded. By increasing the risk of financial failure faced by the institution as a result of institution itself being defrauded. So the risk is when you don't have the kind of proper systems in place to identify the money laundering activities of your customer, then it will lead to your individual customers maybe use your channel, and your individual team, your staff members may also get involved. Then your organization will get basically blacklisted, and overall you will the institution will have to bear huge losses and pay huge fines as a result of not having a proper systems in place to identify these financial sector kind of illegal activities. So therefore it is very important to have a proper systems in place and controls to monitor money laundering and terrorist financing activities. Benefit from proper compliance. Avoid voluntary uncertainty to financial institutions and the public due to unethical movements of funds. Avoid vulnerability, vulnerability and uncertainty. Avoid vulnerability and uncertainty to financial institutions and the public due to unethical movements of funds. That's the when you have proper systems in place, proper compliance in place, then you can avoid any uncertainties, vulnerabilities, to prevent from moving of funds between customers or through your channel for unethical purposes. It is very, very important. Otherwise, your channel will be used for unethical movement. So having a proper control, proper compliance, proper monitoring, where team members or the staff with proper awareness will prevent the movement of definitely and prevent the movement of unethical funds between accounts or through your channel. So that will basically prevent bank being exposed to a level of risk, unnecessary issues, and also fines. To establish a sound and stable economy. Very, very important. Now, when these things are happening outside the banking channel, there is a huge market, unregulated market will be, emerge outside the formal banking channel. So that is not good for any country, financial sector, as well as a country. And we as a country may get blacklisted globally. So some time back we were grey listed by the international institution. So as a result, our cost actually increased. When countries grey listed, the transaction initiated from overseas to Sri Lanka, each and every transaction requires additional scrutiny from their side. So then they are little reluctant to even send a transaction to Sri Lanka through their channels. Number two, even when we are kind of a grey list country, even the insurance premiums have gone up for foreign trade. So the cost of importing has gone up due to the increase in insurance premiums. So these are then even the Nostro. I explained about the Nostro accounts last week. Even our corresponding banks are kind of watch list. Put all our Sri Lankan banks under the watch list for each and every transaction, because in those countries their fines are very, very high. Their fines are very, very high. Sometimes it will go to like 200, 300, $400 million, $1 billion, like that. So there are instances where the fines were imposed to that magnitude. Then safeguard the economy, financial institutions, stakeholder, customers, public and country. So when you have proper controls and you're safeguarding your stakeholders, basically your economy, financial institutions, your other stakeholders, customers, public, and you boost the confidence level, global confidence level, also as a country. Then a lot of people, investors, even the global financial sector, they are very much comfortable to associate with Sri Lankan business community, come and invest in Sri Lanka. They know the proper systems are in place. They know no other illegal activities are taking place. So this is the confidence level in the economy, the banking system, that is very much important. Otherwise, you may not be aware. These things are monitored globally on daily basis, and we are also, most of the banks, I would say almost all the banks have now systems in place to monitor these money movements between accounts, and they use different patterns to identify customer credits, debits, putting to the accounts to identify unusual transactions. Then how Sri Lanka meets AML CFT. CFT means counter financing of terrorism. So we in the previous slide I said terrorist financing. This is the real term they use: counter financing terrorism, counter financing terrorism. So that's the CFT, AML, CFT. There are a few buzzwords. We call the AML, CFT, CDD, then TDD. CDD is the customer due diligence. TDD is the transaction due diligence. AML is the anti-money laundering. CFT is the counter financing of terrorism. So these are, part and parcel of the banker's life now. Because each and every transaction needs to be screened for these things. But it is done, we have certain guidelines for that. So as we go on, we will discuss. There are 3 acts passed by the Parliament. One is the Convention of Suppression of Terrorist Financing Act. This is Act number 25 of 2005. Convention on Suppression of Terrorist Financing. Convention of Suppression of Terrorist Financing Act number 25 of 2005. The Prevention of Money Laundering Act number 5 of 2006. Then Financial Transaction Reporting Act number 6 of 2006. This is very, very important. These 3 acts are very, very important. FTRA, this is the Financial Transaction Reporting Act, is very, very important. Number 5 of 2006, number 6 of 2006. These are 2 very, very important and groundbreaking, acts introduced in Sri Lanka way back in 2006, and even number 25 or 2005. That has really given a different dimension to banking transactions and how it should be monitored, and all this been spelled out in these acts introduced in 2005 and 2006. Then we move to FIU. FIU is the Financial Intelligence Unit under Central Bank of Sri Lanka. This is a very powerful unit headed by a director appointed from the central bank. And these FIU, they have well-trained, qualified team to investigate all the suspicious transactions. So this is actually set up under the Gazette extraordinary number 1951/13 dated in 27 October 2016. This is actually not October, this is January. Then the customer due diligence, that's I call the customer due diligence, is very, very important. Another aspect introducing 2016. So adherence to guidelines issued by FATF. So the Financial Action Task Force, world governing body for AML. These are very important. These are very, very important. And we are a small country, small economy, 84 billion USD, but we can't operate in isolation. We can't operate in isolation because we are a part of the global economy. We are part of the global economy. So we have to, whether we like or not, we have to comply with these regulations and global requirement, different global bodies. So we are, as a country, we have signed bilateral, multilateral agreement with different conventions we have signed. So we have to comply with those things. Otherwise, we will be getting penalized for not complying with those conventions, agreement signed by the our government. Then internal guidelines, basically every bank has a AML policy, then policy on reporting suspicious transactions, then procedure on anti-money laundering software version. This is actually I will take this out. This is I have mentioned the procedure, internal procedure of my bank, but this is a common thing. Procedure on anti-money laundering software system has to be there. Then every bank has a AML monitoring software. So my bank used the MBlock, that is the software available. Some banks may be using a different software, so I'm not sure which software they are using. But that procedure has to be given in writing for users, so that users can use that without any complications. So AML policy has to be there in the bank. It has to be approved by the board of directors, and policy responsibility is with the compliance team. Policy on reporting suspicious transaction has to be there, STR we call. And procedure on anti-money laundering software system should be there. Then procedure on financial institutions, this is called the customer due diligence under the rule number 1 of 2016. These things has to be in place for any bank to comply with the regulatory requirement. And for example, when we take a kind of a, we monitor the transactions, we monitor different patterns. Sometimes, for example, I told you that foreign remittances, to receive foreign remittances through the banking channel, we have our agents overseas. We have tied up with overseas agents, and sometimes there are a lot of people are working overseas in the Middle East, like Dubai, Qatar, Saudi, Kuwait, and these are huge countries except for Qatar and Dubai. But still, these people are living in, that is called labor camps. The a lot of people except for uh, 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 domestic helpers, we call the housemaids, but they are, I would like to use the domestic helpers, the word, except for them. Most of the others are living in labor camps. They have the labor camps. In labor camps, what they do is they take people to the site or construction sites in the morning, and through using the common transport or the dedicated transport of that company, and in the evening after work they take them back to their accommodation. Those accommodations we call the labor camps, and a lot of people are living in that. And suppose there are in a labor camp 100 or 200 people are there, or more than that maybe there may be a kind of a leader for this particular group. So that leader can collect money from each of the their people under in that particular labor camp. And for example, if they are to send money to Sri Lanka, sometimes they need to pay a fee. They need to pay a fee. So instead, one person collect, say, of transactions of 20 people, and send as a one transaction to a single person account. And using the online banking, that person will transfer to 20 beneficiaries in Sri Lanka, using the online banking. So he has basically operated a mini remittance company or the exchange company within the labor camp. So these things are being monitored. Our systems are capable of monitoring transaction routed through that kind of overseas remittance as one remittance, and distributed among the so many other accounts that can be monitored. Similarly, there can be situation where a single person may receive multiple remittances from different countries. That is a one little alarming situation, that is called the terrorist financing. So they may collect money from different extreme groups from different countries. So one account may receive multiple credits. The previous situation where the single account distribute to multiple accounts, that is an internal business they do, that is also not allowed. And using the technology and the loopholes in the system, they are operating that as well. But to great extent, we have been able to counter such operations to the greater extent. And suspicious transactions are the transactions when bank feel suspicious transaction. I don't know whether you are aware of this. Lot of banking channel has been used to do kind of scams to innocent customers. So there, for example, you may be getting a call from me, that you have won a kind of a prize or some lottery, and I want you to deposit some money to my account to receive the or deliver that prize, or deliver the vehicle or tractor or something like that. So you deposit to my account, and immediately I will take that money out from my account in a different ways. One is I will open an account under a forge NIC. Now we have a way of like validating the NIC number. But if some can also, even if we have the NIC validating facility, still some people will misplace their NIC number, genuine NIC numbers, NIC cards, and some people they come and open accounts using those NICs, and unfortunately our people are even not looking at the person's face prior to open the account or ask certain questions, but they just due to they want to immediately open the account and send the person out even without talking. Those are not good, but if you talk to them, and then they will also get little scared. uh, when they open under a different genuine loss NIC, using the loss NIC, they use same thing, 2-3 banks, and you getting the they will also have the transaction online banking facility, as well as SMS notification. So they know when the moment they you deposit money in a flash, they take the money out. Sometimes they use the couple of banks to they transfer between couple of banks and take the money out. So these are the scams. And then these accounts, once we get the complaint from customers, we report these accounts to FIU for further investigation. So all suspicious transactions that is identified through the systems, identified through complaints receiving from customers, we immediately raise a suspicious transaction report, and we always send to FIU for further investigation. And under the STR, generally, we are not supposed to divulge or inform to the customer that we have made a STR to the FIU, because that will sometimes hamper their investigation. Even if we sometimes we may even not put a lien to that account, because that will really prevent them for their further investigation, because they may not use that account for future activities. So these are the things that you need to be very, very careful in handling your transactions of your customers. Then completion of KYC CDD form in line with the regulatory requirement. When opening the account, you must following informations are required, minimum information. Purpose of the opening the account. It is very important. Why they want to open an account? Maybe for saving purpose, maybe for some other purpose. Their salary may be coming to that account. They want to start a new business. So there may be multiple purpose, but it is very important for you to know the purpose of opening the account from the customer. Then source of funds. It's very important. You need to know whether you are a salaried employee, whether you are say you are self-employed, whether you have income from different your shares, whether you have income from other FDs, so how you are earning your living, basically that you need to know. Then only you can profile the customer. Practically, customers like those who are working, these informations are not actually, you just ask customer to just sign it only without, properly doing any evaluation. Practically this is happening with every bank in Sri Lanka. But we need to be very, very responsible, and even at the time of the opening the account, we need to get this information filled by asking the proper questions. So this is very, very important. If you miss the first point, then customers will take us for a ride, rest of the period. It is very important for us to get the first, KYC done. Know your customer. KYC is a know your customer done for our expectation, our satisfaction. Then expected monthly turnover levels of income. This is very, very important. If I say my level of income is 100,000, monthly income is my salary is 100,000, and if I get a credit of 10 million or 1 million, it is not in line with my declaration. So then system should be able to identify it is my income. This is a kind of a suspicious transaction. Then further investigation or inquiry can be made. If I declared my income is 10 million, even without asking, you just put 10 million to the form and the system, what will happen is up to 10 million you will not get my transaction notice by the system. So you have without knowing or unknowingly, you have helped me to do illegal transactions through your bank using your banking channel up to 10 million, up to 10 million. So systems, it is very important to get the required correct information filled by the customer and entered to your systems. The expected mode of transaction, some may be getting involved in self employment. Then you can say, like, I will be getting foreign remittance. My husband is overseas, my wife is overseas, my parents are overseas. So I am expecting every month, say 100,000, 200,000, or $100, $200, whatever that has to be gathered and entered into your systems. It is very important. Then expected type of counterparties, who are from whom that you get, and also who are your joint holders, who are the beneficial owners, that need to be now. Nowadays I may be having money. Say I have 100 million with me. Now I know if I go to a bank will number one, bank will question me. Number two, I may be liable for tax. So since I have not declared my income, I may be liable for tax. So therefore, I may use a dummy. I may use a dummy to open the account. I may sometimes request one of my domestic servant to go and open account, and I will put the entire money under her name. So then what will happen? So I will nominate. I will get my name to be nominated in the forms of the bank, official forms of the bank. So mine, I will not be highlighted as the main account holder, but I will be the nominee. If something happens to her, I will get the beneficial. This is called the beneficial ownership. So now even beneficial ownership is very, very important, and all the banks are required to even identify the beneficial ownership owners as well, who are the joint account holders. Sometimes one party may be totally innocent. His name will be used to hide certain things. So you bring them innocent party as a joint account holder and put him to the operate the account. So that is also under the rule of survivorship. If something happens to the joint account holder, the other party is entitled for the full amount. If there is no joint account holder, then the nominee will get the full amount. this is how the rule of survivorship and the nominee will differ. Under the rule of survivorship, joint account holders are the, if something happens, other surviving joint account holder is entitled to the full whatever the remaining balance in the account. Okay, but if there is no joint account, nominee will entitled for the balance in the account. If there is no nominee, if no joint account holder, then the last will come to play. Last will come to play. Then you have to prove the letter of go to the courts and get a letter of probate. If no last will, then you have to file a case by the your beneficiaries who have all the dependents to claim the disease estate. Then we will the beneficial owners, customer not a natural person. Beneficial loan is a customer is not a natural person. Measures to understand the ownership and control structure of the customer. Then determine the natural person who ultimately owns or control the customer. This is very important. You always put a dummy, and you will always stay behind. So identify the beneficial owner or the real person. The systems has to be in place. Then number two, one or more natural person acting on behalf of a customer. Natural person who act on behalf of the customer shall be verified through documentary evidence, power of attorney, authorized signatory. So the different type of arrangements are there, or people used loopholes in the banking system to hide themselves and open accounts and operate without getting themselves noticed, and even if something happens, still they are not be liable. So that is the model. So bank has a major role to play, and play a compliance role to play, to prevent the banking system is being used for illegal activities. So we have discussed AML, anti-money laundering, counter financing of terrorism, transaction due diligence, customer due diligence, know your customer. So these are buzzwords. Then beneficial owners. These are buzzwords in banking and compliance. These are buzzwords. At least you should know. You need not go into detail, but at least you should know what is AML, what is CFT, what is suspicious transaction, what is beneficial, who is beneficial owners, who is what is know your customer. Then transaction due diligence. Each transaction should have a underlying reason, underlying reason for that particular transaction. If I get a 100 million credit to my account, it is the responsibility of the bank to inquire from me what are the sources of document, what is the underlying transaction. So these are very, very important. Then customer due diligence, whether we have done it. Know your customer, very, very important, very, very important. Then under the compliance, now we have discussed AML, CFT, CDD, TDD, beneficial ownership, KYC. Then we will move to a very, very important thing. This is also politically exposed person. We call the PEPs. PEPs. Why this is also a requirement? Politically exposed person means an individual who trusted with prominent public functions, either domestically or by foreign country or in an international organization, and includes a head of a state or the government, a politician, a senior government officer, a judicial officer or military officer, a senior executive of a state-owned corporation, government or autonomous body, but does not include middle rank or junior rank individuals. So this is a very, very detailed document. I will not, it has clearly articulated the ranks. Like if you say brigadier or CAS officer, so likewise, so they will also fall into the PEP category, even though they are not a politically kind of physically involved in politics, or they are not a member of the parliament. Still, certain like judicial officer, judicial officer is not a politician, but under the PEP, judicial officer will fall into this PEP category. Then military officer is not a political personality, but still the as far as I can remember, the officers above brigadier will fall into the PEP category. Then senior executives of state-owned corporations, government or autonomous, then government officers. So these people will come under PEP category, and they even uh, when they open accounts, they will be these accounts will be separately maintained and need higher authority approval within the bank. And these there may be internal directions from each bank how to open politically exposed persons, what kind of approval is required, then what kind of information or the is required. Even political person engage in politics or who is not a member of the parliament, even have any political links, even the staff of political people, political personalities, then members of provincial councils, members of parliament. All these categories are falling to this kind of scrutiny, and their accounts are being monitored closely. Then sanction list screening. Globally, there is a Dow Jones. Then there are sanction screening platforms. All the banks are required to sanction screen for all inward remittances, then your trade business, then your basically all your even if you are supposed to open accounts with other foreign banks or whatever, you are supposed to do a sanction screening and satisfy yourself that you are not party from whom you are going to get money or send money, whatever, is not a party that will listed in the sanction list. So this is a UN regulation number 102 2012. So since 2012 this is in place, and day by day this is getting the list are getting increased. The sanction list will gives you a list of criminals, people engaged in terrorism, money laundering. So they will be drug trafficking, human trafficking, all names who have been caught by doing all illegal activities have been listed in those lists. And every day for my bank, we are download the screening, our all transaction, and the screening will be done prior to processing the transactions. So all inward remittances, all in like worker remittances, even all inward other remittances coming through the SWIFT will be screened, and even all LCs will be screened, all for sanction list. It is very, very important, and it is a mandatory because there are a lot of people names. This is a challenge we have. Certain names are in Sri Lanka, our names are very, very common now. Certain names because our systems have been configured to identify by first three digit letters or common names, something like that. So it is very difficult because sometimes our names are very lengthy. Sometimes we have very common names. In if you say certain names, I don't want to, like, I mean, not to mention to one religion or one kind of community, anything. But if you say Muhammad, it is, it's a very common name. So a person who has a Muhammad coming regular transaction, which is also legitimate, but they will because of the name certain it will get kind of screened and listed under watch list sometimes due to the name thing. So if you say some De Silva or some common name can be even other customers may also fall into unnecessary issues sometimes due to the name factor. Even if you go to certain countries also, this issue is there. When they screen your passport, sometimes maybe your name may be listed due to some other person's activity under watch list. So they will look at and sometimes you may have to undergo different kind of hassle at the airport due to these screening. So this is the thing. So better you be a little aware of these things, what is happening in the bank at the back end. Front enders may not have such a wide knowledge about these activities, but since you got some idea about how compliance is doing, what they do, what they look at, and what are the things they basically they are required to do by mandatory. It is now better when you are a front officer, you be a little vigilant for these things. Then I have explained to you what STR means. STR is the suspicious transaction reporting. Excuse me. Any transaction or attempted transaction related to commission of any unlawful activity or any other criminal offense under the FTR is the Financial Transaction Reporting Act. This is an obligation under the Section 7 of FTR. I told you the FTR is a very, very important act, number 6 of 2006. So that is one of the important acts enacted by the Parliament in relation to financial transaction. So under that, there are certain obligations from the bank point of view to comply with that, and the central bank, especially the FIU, is following very, very closely monitoring these things, these patterns, and they send certain guidelines, conduct training, and they are highly committed to basically ensure that our systems, banking systems, are not used by the criminals for their illegal activities. So that is the objective, and we as bankers also need to cooperate and commit ourselves to ensure that our uh, our channels are being used for legitimate purposes only. So if you even have any kind of a suspicious or some a known activity, it is your duty as a responsible banker to bring to the notice of your authorities, and then to the respective parties for further action. Right. Then transaction monitoring part, according to the section 5 of FTRA, where every transaction institution should conduct ongoing security scrutiny of customer transaction that is being conducted with the institution's knowledge of the customer's bank, business, and risk profile, where necessary the sources of funds. Further, every financial institution should implement the process of monitoring required under Section 5. So Section 5, so we discussed Section 7. These are very, very important sections. So under that, the risk profile is very, very important of the customer. So you profile the customer in your system. So your system, whether you have the machine learning or AI or whatever, will basically capture the data and highlight anything outside the profile that you have given to the system. Any transaction falling outside your risk profile will be highlighted by the system. So it is very important to profile the customer properly. If you don't profile the customer properly, you may not even be able to track their transactions in a proper manner. So therefore, it's very important. Then frequently asked questions, occupation, nature of business, you should know. Sources of funds, you should know. Transaction is in line with the business volume, you should know. Then due diligence complied, you have to say yes. Then KYC CDD has been completed, you have to say yes. Transaction in line with the business, these are the things, the screening process basically. These are the screening process. So if you don't profile with transaction in line with the business volume, if you say 100 million, you are, without even your knowledge, you are allowing people to do illegal activities. So that is what you need to be very, very careful in compliance. So compliance is one of the key areas that you need to be aware, and at least today onwards, you should be able to understand certain words and also be vigilant, and when opening accounts, you should be able to look the person face at least, even if they come up with a identity card, not as a, don't look at him as a rogue or anything like that, but in a very subtle way. Being a bank, you should be able to identify the purpose of opening the account, why they are. Sometimes their address may be in a different location, remote location, and they want to open the account in a totally different location. So then you need to inquire and identify why. So my address may be in Badul and I want to open an account in Colombo. Then you must know exactly why I should come and I want to open account. I must have genuinely relocated myself. Then you must ask for a billing proof. Billing proof. This is very important. You must ask for a billing proof from me. Then so these are then when you check, if I come with a not forged, I would say lost identity card. I found from the street. Then I want to come and open an account with you. Then at least you must find out whether previous account is available in your system. You must ask certain questions. Sometimes if previous account is in the system, you must check that his signature can be checked, his data can be cross-checked. He may have only the identity card only, but your system may have more information of that particular customer. You can ask the last transaction, so of the or the previous, whether you can ask whether you have account with us. He may say no. Then then it will be a you can further question him and get yourself clarified. So these are the things that from compliance point of view, in retail banking, this area is going to be a very, very important, critical in the future. So one of the two areas, like risk area and compliance, these are the integral part of business in the future. So without compliance, without risk, you can't do business. So this is the challenge all of us will have in the future. Day by day, these, because we introduce compliance, risk, very, those are very new to banking relatively, and it's developing day by day, and new systems, instructions are coming in by and issuing by the regulator. So these are the areas, even your careers need to be look at in these areas, because that will have a more demand in the future. Right. So let's move to investment banking. Only a few more slides. These are very the services offered by the banks, rather specialized arms of the banks. Investment management firms invest their clients' money. That is obvious. They choose the right selection of investment, from fast-growing risky stocks to safe but slow-growing bonds. So it is all investment managers or the management or managers' role is to identify the client expectation, client requirement, and cater to that. And sometimes client may require longer term investment, client may require short term return, client may require medium term return, client risk appetite may be different. So based on that, investment management or the manager needs to select the right investment for his client. The aim is to achieve the return the client needs at a level of risk they are comfortable with. This is very, very important. Different clients, different customers, they have different risk appetite. Risk appetite is very, very important. Identify that risk appetite is key, because some customers are generally risk takers. They, high risk, high return, but some are risk averse personalities, so they don't want to take risk, but their return is also low. But investment manager needs to identify the risk appetite of the customer. It is very, very important. Then investment manager management firm take on all the effort of creating an investment portfolio for their clients and open up new investment opportunities that would not otherwise be available. it is the investment management firms or investment managers' task to create a good portfolio that will diversify the risk. It will create a different type of yield profiles with different maturity yield maturities, and create a different opportunities. Otherwise, as an individual, that client may not be able to get it. With that, the expertise, they should be able to cater to clients' requirement after ascertaining the client's requirement as well as client's risk appetite. They should be able to invest in such a way that will create a higher return for the client than the client individually investing on the same same portfolios, so all different portfolios. So that is the expert advice they expect from the investment management firms. Then investment management firms works for all the different type of clients. They have the wealthy individuals. They have the work with companies, charities, trust, and major corporations. So these are the main functions of investment management companies. So the key task of investment management: assess clients' financial goals and attitude to risk, monitor potential investment, create investment strategy. Investment strategy is very, very important. Diverse the portfolio depending on the risk level to mitigate the risk. And sometimes all the if you are investing everything on one stock, that is high risk. If something happens to that stock, your entire investment will be at a high risk. So it's different how you diversify. It can be sector wise, it can be amount wise, it can be there will be fundamental stocks, there will be stocks that can be traded on a regular basis. So you diversify sector wise, maybe banking, maybe some other manufacturing, maybe some other apparel. Maybe likewise you diversify and ensure that you will not be get hit due to the single activity, because the market is such that a lot of macro level functions are happening. So macro level understanding is key, because the government at the first day I have mentioned the GDP growth, the government policies, economic factors such as interest, then inflation, uh, foreign exchange rate, the trade gap. All these factors will have an impact on the market. So the for investment management firms needs to take all these factors into consideration, government policies, everything into account, and diversify their portfolio to ensure that their clients are not get hit due to the impact of single factor to the one sector, or maybe to even multiple sector. It is their professional expectation from them. Then we'll move to how to do investment management firm make money. The profit they make for their clients, the more money management firm makes. And they charge their client a management fee and take a percentage of the profit for investments. This is how they operate. They get a management fee, as well as they share profits with the customer as well. These are all depend on the individual agreement Some fees are standard, maybe anything regulated by the regulator or the government by statute, because they can't deviate from that. But other than that, any other thing, these things can be agreed upon with the customer, so that customer will be also liable to abide by the agreement. So these conditions stipulated in the agreement cannot be contravened with any other regulator requirement or country law. That is very, very important. How do management service work? Investment manager firms requires you to set up an investment account with them or at a brokerage they use. Brokerage in the sense broker company. Investment management is maybe an independent firm. Brokerage may be an independent firm, but these two may be under one roof of another holding company. So this may then investment manager or the management firm may require their prospective client to open an account with their brokerage company, brokerage arm. The manager's investment decisions are based on the variety of factors, starting with your savings goals, retirement, education, large purchases, and the time frame. They will also evaluate your risk appetite. Investment strategy will be formulated suit individual expectation. This investment manager's role is to identify the objective of the client. Client maybe have one objective or multiple objectives. They may sometimes may have a retirement plan. They may want to educate their children and have a plan for that. They may want to buy a house, vehicle, or some other investment property. So based on that, then the investment manager's decision will have to vary. Then you need to identify the time frame for that. How long you will have from today to achieve that goal. Say I will be retiring, say in other 25 years time, and what is my expectation, what would be the inflation at that rate, what would be the interest rate at that rate, and I have to do my maths and see what kind of amount I should get it after 25 years for me to have a decent life or decent living. So this is very, very important. Sometimes now if you don't calculate and understand the present value of that money, and sometimes you may see it's like a big amount, but if you do the calculations and see the level of inflation is going up, and the rate what would be the interest rates of that period, and discount that, it will be a very, very negligible amount after 25 years. So that whatever the investment make with the objective of having a good life, a better life, a quality life, after 25 years, I may not be able to achieve it. So then the investment manager or the decision of the investor is to highlight and all these areas, educate them, the customer, and to help him to achieve his goals by putting in the right investment, right amount. Everything is very, very important. Otherwise, you just for the sake of taking the investment, you may not be available with the organization after 25 years, but this person will suffer. This person will not be able to achieve their objective. So that's a kind of advice I can share with you. Always, even when you are as a banker, you always be very, very genuine. Your whatever you advice give should be for the best interest of your clients, and that will really help you to develop a long kind of long-term relationship, and they will trust you. And for example, if customer comes to me and say I have 100 million to deposit with your bank, and expect a professional advice from me. If I say, even if you invest in my bank, I may have a deposit. For example, on top of that, I have 100 million deposit target that will have a direct impact to my bonus. Then what will happen is, I have two options. One thing, give a wrong advice to the customer and get the deposit to my bank and get my bonus. So that is a wrong professional behavior. I have an ulterior motive to receive my bonus by giving a wrong advice to my customer. Customer will also one day will realize that I have given a wrong advice, and it will be a damage to my relationship as well. Sometimes he may not even come to my bank. If I give you the correct advice, even basically forgetting my bonus, I say, sir, in our bank we gave only 5%, but there, if you invest in this account with this bank, or bank A or B, you will be able to earn 5.25%, 5.5%, and you can earn additional income out of that. So that advice, sometimes customer will really value that. He will not even move up for some small benefit. He will say, that's okay, since you are also giving 5%, I will stay with you, will forget about the other bank, because I am very comfortable with dealing with you. Then you have given the right information to the customer and make him comfortable. So he has really valued that, and he's remaining with your bank, and your relationship is also maintaining. So that is what we expect from the professional advisors. One day you need to elevate as a financial consultant to your customers, and that kind of a genuineness beyond your personal gain need to be practiced. And then you, on the long run, you will be respected, regarded by your customers. Then we'll have different type of investments. Stocks you can invest, bonds you can invest, excuse me, mutual funds you can invest. Then you have the bank products, mutual funds in the sense the unit trust. You have bank products like fixed deposits. You have debentures. Then you have the treasury bill, treasury bond, and the bonds. Then you have bank products, savings. Some banks have different products with a higher percentage for savings. Then you have fixed deposit for 3 months, 6 months, 12 months, 1 year, 2 year, so 12 months, then 2 years, 3 years, 4 years, 5 years. Depend on the interest rate and future expectation, you can then you have the options. In Sri Lanka we don't have the options. Then annuities also very we don't have annuities. The retirement plans you can invest. Then savings for children. Then money market transactions are there. Then banks have different markets. Central bank they have let me explain this way. Central bank have special deposit facility rate, SDFR. That is the rate that the bank can deposit with central bank. Then they have another thing called special SLFR, special lending facility rate. That is the rate they can lend to bank based on the securities. Then they have another rate called the bank rate. Bank rate is when bank is in a short of funds, they can take it from the central bank without security. Present rate is 9%. So between the SLFR and the SDFR, there is a market happening between 5 and 6, that is called the interbank money market. It is between the commercial banks are participating, and banks who have excess money can lend to other banks and earn more than 5%. I would say more than 5%. If you lend to central bank, 5%. But within the 1% margin, there is another market operating, that is called the money market operation. So the money market operation, central banks involved, whoever who has excess money can sell it to other banks, other can sell it to settle separately. This is called the money market operation of different banks. So that's how it's operate. Then in addition to that, we have the repo and reverse repo. When repo is the operation that central bank when they sell their products with a view to buyback, it is a reverse repo. When a bank buy a repo from central bank with a view to sell back, it is a repo. When central bank try to sell a repurchase agreement to a bank with a view to buy back, when that is called the reverse repurchase. When commercial bank invest in a repo with a view to sell back, then it is called the normal repo. So this is, you need to understand repo and reverse repo. Let me explain again. When you take money and get a repo with a view to sell back, it is a repo. With a view to any instrument that you are getting with a view to buy back, then it is called the reverse repo. That is the two terms used by the central bank. Then role of investment management industry. There are roles as investment managers. Firm include analysts, investment managers, risk managers, traders, sales. So these analysts, these are the roles involved. So these has high demand, like analyst, they call the equity analyst. We have business analysts, different type of analysts. So they are qualified people, and they do all these calculations, long-term calculations, and even some what do you call there are long-term calculations done for different funds like pension, and there are qualified people who have the CFA and all other qualification. They are called actuarials. So they do calculations using the high different multiple tools, and forecast the future requirements, future returns using the technology. And these are the roles available in investment management industry. Then we'll move to wealth management. Investment management, we discussed about the broker and the dealer. Broker is the initial stage, and when you mature and when you get more qualified and expose yourself, then you will become a dealer. You will become legal. Similarly, dealer is more than the broker. Similarly, we discuss about the investment manager, investment management. The wealth management is kind of which include investment management. This is wealth management is part of wealth management. Wealth management is a part of investment management. Management is only part of wealth management. This is the explanation. Wealth management is an investment advisory service that combines the financial services to address complex needs of high net worth client. Complex needs, very, very important complex needs. They have multiple different complex needs of high net worth customers, so they need to manage that. Wealth management is more than just the investment advice. Investment advice is sometimes you are only tackling one set of their assets or their maybe clients' assets, but this is a more holistic view and managing the entire asset or the wealth of the client. The financial solution may plan to cover different stage of one's life. In the investment is also similar. We cover different purposes like education to retirement to your other high purchase activities requirement. Similarly, this will also encompasses the different stages of your life because that is a part of wealth management. This is a professional service offered by financial institutions such as value-added service to their top client. These services are custom-made, tailor-made to individual client requirement. You don't have one menu for all the customers. So it is a customer-made or the tailor-made solution based on the client's need. So these services, therefore, is very, very important and very, very the high professional competencies are required. So this is a consultative process to evaluate and identify clients' expectation to provide personalized solutions through proper combination of financial products and services. So these are the general services available for wealth management. The money market, mutual funds, portfolio management, overdraft, wealth management in the sense sometimes you manage their estate as well, wealth plans. These are offered by these different organizations, banking arms for their individual clients, private clients, and institutional clients. So they manage it. Even sometimes wealth can be managed. It can be you can be appointed as the executor or administrator. So under that also sometimes you are required to manage the wealth or funds for and hold the wealth and manage it for the benefit of beneficiaries. So these are the how you will get interconnected these things. Then we'll move to the last slide. Wealth management is an investment advisory service offered by financial institutes that combine other financial services to address the complex needs of high net worth clients. Wealth management is a tailor-made financial solution designed by the competent professionals. Very, very important. You and I can't do that. These are well-trained, highly professional people are there to advise and manage these kind of services to provide financial solution based on the client requirement. Bank provide this service for a fee. This service is usually appropriate for wealthy, net worth individuals who wish to get professional service to manage their wealth to satisfy complex needs. If you are suppose I have a very small wealth, I have everything, if put it together, I have a small amount, say 500,000. So these, if I go and ask or request the service of a wealth manager or the wealth management company, they may not agree, because whatever that my amount is not sufficient enough for them to make a good return, because of the cost benefit. They have to allocate a person, manage that. They have to incur administration cost. They have to incur staff cost. So based on that, they may not agree to manage my 500,000. So instead, they prefer to allocate whatever the available resources to high net worth individuals, where their asset value may be in billions. So that's the simple logic of these people. So therefore, as wealth management will be basically done by the companies or the financial institutions on behalf of their very, very high net worth clients, not for very individual clients with small amounts. So we have come to almost to the end, because I was supposed to cover 10 areas, which I know is very, very new to you, and sometimes maybe first time you may be hearing these things or areas. So, but the expectation of this your diploma is to give you a kind of insights. What are the services available for to generate fee-based income for banks. So as I mentioned to you before, banks' profitability is coming shrinking, because how bank make profit is deposit, the difference between deposit, what you pay for deposit and what you get from lending. That margins are coming day by day shrinked. I don't know whether you are aware, when we take 100 rupees as a deposit, we are supposed to keep 4 rupees with the central bank without getting any interest. Then also we are supposed to keep 20% as liquid assets in the form of treasury bill, in the form of treasury bond, in the form of sovereign bonds of rupee sovereign bonds, in the form of Sri Lanka development bonds, in the form of nostro account balances, and in the form of cash balances up to 3%. So that is how the liquid ratio is calculated by the central bank. Then we are left with only 76% for us to lend. Then we need to know what rate we need to lend 76 rupees, because we take, for example, we take deposit for 10%. Then we have taken 100 rupees. At the end of the period, we have to give 10 rupees to the customer. Then we have to give 110 rupees for the customer. Now, to make 110, we have only 76 rupees with us. Then, what is the price we are going to, lend, will always depend on the break-even point is 110 plus our the profit margin, administration cost profit margin we need to add. Generally it is 3%, so it will be very much higher than the 10%. So sometimes as bankers, people may come and tell you, even a customer may come and tell you, look here, you're giving only 10%, and when we want a loan, you are charging 15%. So it is very unfair. Why are you keeping 5%? You give it to for 10.5%, 11%. So these are the common things. Then you need to explain these to customers. Then because we all finally need to protect the industry and tell them and educate them why we are charging that rate. Maybe why we need to charge is when we take a deposit, we have only 76% to lend. If the SRR, the statutory reserve requirement, increase further, when we joined, it was 10%. When we joined to the bank, it was 10%, and subsequently it was reduced to 7, and then made it to 2, and then recently increased again to the 4. So why they use the statutory reserve requirement is to control the money supply in the market. That is the objective of that. So you need to know these things, and your diploma, retail banking diploma, will basically cover the areas and give insights to impart knowledge of basic banking, and especially the retail banking has become very, very challenging. And these 10 areas are the areas that bank can look for to generate additional income, except for the last one. That is also basically money laundering constraints, and know your customer will help you to stop leakages out of your channel. If you if you are found guilty of allowing your system for money laundering, you are subject to a heavy penalty. So that then what will happen is your profits will drain out. So this will help you to put the system in place and safeguard your reputation as well as your profitability. So these are the very simple thing. And so we have another basically 20 minutes. You can ask any questions. Any questions from you?
Excuse me, sir. Related to the broker service, now normally the banks are now doing broker services and wealth management. So
Yeah.
how is the responsibility mitigate from the bank side? So that means so we
because
need to.
These are the services offered to get additional income to the bank. Sometimes some banks are doing within the bank operations itself, or some banks may have specialized arm to handle this kind of operation. But all these services are properly, they enter into an agreement with the customer. After entering into the proper agreement and signed by required clients, then only these services are provided. So whatever, each and every bank will have their own agreement covering all their liabilities. And this is what I want to I shared. It is very important to tell the customers of what their responsibility, what are the things that bank will look after, and what are the things that bank will exclude. All these things, it's better to educate upfront, so there won't be any kind of uh, uh, any kind of misunderstanding or future conflicts. It is basically, for your question, these services are offered under an agreement.
Okay, sir.
So when it comes to PEP clearance in account opening, once we identified that that person is politically exposed person, so what is the next step that we are going to do?
No, these PEPs are there. We need to either, once we identify, you have to, like, each bank has a process to follow. It does not mean that you can't open an account for PEP. PEP, we can open the account, but with proper approval, and your systems has to be system should be able to identify the PEP separately. The transactions done by PEPs need to identify by the system on a regular basis, and they will be under scrutiny. So that is the difference. But even a president can come and open account, prime minister can come and open account. There is no issue in that. But they are, all transactions are subject to scrutinized by the system. But from bank to bank, there will be some operational different guidelines issued by the bank. Say some bank, maybe the manager can be authorized to open the account. Some you have to be sent for your regional manager. Sometimes you up to the corporate management. So these, under the guidelines of each bank, who has the authority is differ.
Thank you, sir.
Sir, hello, sir. The SLTB fundraising bonds are there, no, sir? If hello.
Yes.
If the foreign currency fixed deposit customer, those funds are interest higher things, no? So if they purchase that from our fixed deposit, what the effect it will take to our branch bank profit, sir? Is it going out from our bank's portfolio?
Yes, if you any amount invest for Sri Lanka development bonds, maybe Sri Lanka development bonds, it will be under separate. Your portfolio will reduced. Your portfolio will reduced, but the customer will get a higher interest. Sometimes these development bonds, sometimes like when certain bonds are there, they banks can get it in the primary as a primary dealer and resell to your customer. Resell to your customer and make a profit. But higher rate, if foreign currency higher rate offered by the central bank for SLDBs, then they people can more and go and invest in those bonds, but it will reduce your portfolio.
Thank you, sir.
So, is intermoney market and call money market are same also?
Yes. Yeah, call money market and interbank market is the call money market.
Okay, sir.
Any other questions you can ask?
So if we open account, when we find the person against anti-money laundering or KYC, so how we need to react for that?
So you better, if you have evidence, then you have to suspend the account and report to generally FIU is advise not to suspend the account, and because it will hinder their investigation. But if you have concrete evidence that the money, your account being used for some other activities listed as in our list, like drug trafficking and all these things, then you can immediately certain restrictions can be put it, like if you without freezing the account, you can only allow credits and without debits. So then whatever put it to there cannot be taken out. So sometimes if you freeze the account, no debit or credit can be performed to that particular account. Then you will be basically not be able to trace the future transaction, but it has to be immediately escalated to the FIU. That is a must. You have to report 10 with the all what your evidence, then they will immediately initiate, and they will also send that detail to all the banks. They circulate asking for the bank account details of other banks under the NIC, particular NIC. So it is paramount important to inform to the FIU. That will, the informing to FIU through should be done through your compliance team. You can't just call and tell.
Okay, sir. Thanks.
Any other questions? We have more time. I'm happy to help answer any questions. As future bankers, you will have a better career and longer period in the banking industry. So whatever bank you are working for, it is very important to upgrade yourself. Future competency will be totally different. So therefore, dedicate yourself to upgrade the knowledge, and even in whatever the bank you are in, they may not be able to rotate you frequently to different areas. So sometimes due to shortage of staff or whatever reason, your rotations will be slower than expected. So don't wait until your HR will rotate you to a different area to learn those areas. It is very important to at least dedicate half an hour daily to learn new things. There are short videos, a lot of articles, you can search the internet, you can learn a lot of things. We also still learning, and a lot of things we need to learn until our death. We need to learn. We only know very, very little in the entire banking. So therefore, try to be very, very competitive by through your learning and acquire new things, and even learn from anybody. If you even don't know, ask from anybody and update yourself. It's very, very important. And even through this diploma, you have taken a right decision to get part of this diploma, and try to learn not only for examination purpose, but try to understand the concepts properly, and try to be a very important knowledge hub within your bank. It's very, very important that. So you will be then, you have a you will have to create a demand for yourself. Your brand proper have a brand name that you are a knowledgeable, very competent, very skillful person within the bank. So that is very important for your future, whatever your bank you're working for. Try to redo your sums using the concepts I have given you with the answers, and try to understand on your own what are the things. First, you need to understand whether you divide or multiply. Then second, you need to understand what bank is selling the bank is buying the base currency or selling the base currency, or bank is buying the quoted currency or selling the quoted currency. Then you need to apply the rate. That's it. Not more than that. But only additional thing under question 4.5, you need to know before what is premium and discount, and if it is a premium, you have to add to the whatever the applicable rate. Whether you need to first identify what is the applicable rate, then you need to apply the add that premium to the rate, applicable rate. If it is a discount, you have to deduct that rate from your applicable rate. It is simple. So summary, you need to understand whether it is direct or indirect. You have to divide. Then I have told you, if it is a direct, you deduct the quoted currency, base currency. You deduct the quoted currency from base currency. If it is indirect, you deduct the divide the base currency from quoted currency. If it is direct, indirect, direct, then you have to multiply. Then you have to, that is the first criteria. Then you have to identify which one, what is the bank role, whether buy or sell. Buy what? Buy the base currency or sell the base currency. Then you have to apply bid rate or ask rate accordingly. Then if it is buying quoted is the opposite of bank buying the bid. Buying bid and selling quote is the bid rate. So that is the thing that you need to understand. That is the only catch there. You need to understand that. Bank always, in my definition, it is very clearly, it says bank, the bid rate is the rate at which the bank is going to buy the base currency or sell the quoted currency. Ask rate is the rate at which the bank is going to sell the base currency or buy the quoted currency. Then you need to understand whether bank is buying the base currency or quoted currency. Bank is selling the quoted currency or base currency. Then apply the rate. apply the rate. That's it. If it is a premium, you have to, before you divide or multiply, you have to add the premium, whether it may be either bid rate or ask rate. As per the question, you have to add that. If it is a discount, you have to either deduct the ask rate or a bid rate. So that's simple as that. When you go through this, you will understand the questions, and you will be able to you will be very, very competent to handle this. Then after you get competent in this, try to teach somebody else how to calculate the cross selling. Then you will learn better. Any other questions? Any participants who is involved in these type of operations like safe custody, safety lockers, investment banking, wealth management, whatever we have discussed today or and the previous day, any participants who is actively involved in doing that? To have any questions, you can call me, not 777 310 375. That's my mobile number. I'll repeat again, not 777 310 375. My email address, Kusal De Silva, KUSALDESILVA, one word, Kusal De Silva, at Sampath, SAMPTH, sampath.lk. And if I don't answer your phone for some reason, if I'm busy or whatever, just put me a message that you are a participant of this IBSL Retail Banking Diploma, and I will definitely call you back to your number. So that is assured. I will call you back in the event if I don't answer for some reason. You just send me a WhatsApp message that you are so and so. Then I will call you back, or normal message, whatever convenient to you. Or you can drop an email. I will respond to you.